Hey, this is Mike Swanson, Wall Street Window. I want to talk with you today about this chart. Now, the last video I did, I was just talking about the short-term action. That's what we all talk about. That's what we all think about because that's what impacts us day by day if we're trading or investing in the stock markets or other markets. But underlying the daily action are the long-term trends, which, they're kind of invisible to most people. They don't really understand what's really happening in the markets. Um, and there's a lot of expectations among people that the way to make a lot of money is to take on risk, to gamble in a crypto coin, to put all your money in Tesla stock or a penny stock, or do something really risky. Um, and we've seen bubbles form in all that over the past couple years. In that bubble environment, people are expecting that to return. A lot of people got into trading in 2020 after the bottom was made, and they experienced that move up in the markets and saw these bubble things go up. And they're still trading and investing as if we're in that environment, and we're never going back to it. And I'm going to show you why and how to adapt to that so you make money. But I've seen this before. Uh, there was a bubble in internet stocks when I first started trading. It went bust, and then a bubble formed in real estate that peaked out in 2006. Real estate prices around the country, and it went bust and drug down the entire economy with it. Now, I'm not saying anything like that's going to happen. I don't think it is. But I just want to point out to you that we've seen or lived through an extraordinary period in the financial markets. And ironically, understanding that is one reason I'm more bullish this year than most people are, despite everything I just said. The stock market, the S&P, fell over 20% last year. The ARK ETF got devastated. Crypto got devastated too. But that decline happened after a massive 100% move from the lows of 2020 to the high made in January 20, New Year's really, 2022 for the U.S. stock market. So we had an extraordinary boom, an extraordinary decline last year. And that boom, of course, happened after the stock market crashed when everything was shut down and locked down in the spring of 2020. So we have had extreme volatility over the past couple years. And one way I measure that is by using the 200-day Bollinger Bands. Look that up on Google and study what that exactly is. I'm not going to, if I go into detail about everything, I'll be talking for hours. But those bands measure real price volatility, and I'm using a long-term 200-day measurement of them. And when they get wide, volatility increases. When they get closer together, it shrinks. And the volatility has actually been shrinking now. And that's really what's been happening this year. So you've been seeing a lot of people probably saying, oh, the stock market's going to dump. This news is going to hit and everything's going to dump. And it's not dumping because we're not in the type of volatile environment we were in last year. I think this year is actually going to be a year of low actual price volatility, unlike the extreme volatility we've seen in the past 2 years or 3 years now. So that's one of the things that's different now and why we're not going back to the way things were before 2022, or one of the reasons. Now, again, also a lot of bubbles were formed on the move up, just as those last two bubble periods I spoke of that I lived through and traded through. Now, there's a macro trend that is also another reason why we're not going back to the way things were. There's not a new bubble coming, and bubble investing is not the way, or trading is not the way to try to make it. Forget it. When people are hyping you up on this is the next bubble, AI, this some fad, that's those fad type trades, bubble chasing. It works and it's a creation of low interest rates. So when the Fed took interest rates down to zero in 2020, that's what forced the stock market up. They create all this money in the system that creates bubbles. So crypto went up. So ARK type stocks, the stocks that Kathy would invest in, they went up. And a mania could develop in several stocks. Tesla became a mania, and it still is a mania because this year, 1/3 of all individual stock trades among individual investors is for Tesla. If that's not a mania or a bubble, when 1/3 of all individual stock trades are for one stock, I don't know what is. And that's not a stock like General Motors or Google or Microsoft or Apple or Walmart, or that people are even using. The majority of people in the country are spending money with that company. They're not with Tesla. So it's kind of a funny situation, even when you think of it like that. But interest rates aren't going back down to zero. They're not going back down in any meaningful way anytime soon because we're in an inflationary environment, which changes everything. But look, the bubble in real estate happened when the Fed cut rates from 6% to below 2%. That's what fueled the bubble in real estate. Just like when the Fed took rates down from, what was it, 3.5 to zero, that fueled the bubble that we last seen. And when the Fed took rates down from over 8% down to below 4% in 98, that helped fuel the bubble in tech stocks. But these bubble situations and times, look at the 90s, 95 to 99, the NASDAQ went up the S&P, went up 5 times in value. From the low in 2002, it went up pretty good too. And people are thinking that's what they're expecting, like what they experienced the last, before 2022, with these big gaining years, from 2016 to 2022, they're big gaining years. And that's what people who are bullish are expecting. But I'm here to tell you that I don't think we're coming for a big gaining year because interest rates aren't going down because we got inflation. This is more like the 1970s. So, yeah, I think the stock market can get back up to the highs that were set a year ago. And I think, this year will be okay with low volatility. But, I don't think we're set for years and years of back-to-back 20% returns, and big riches and big promises and crypto coins making people rich overnight. We're in a different environment, which requires diversification. Having some money in CDs where you can make a stable portion of your portfolio actually makes sense now. I'm not saying go out and buy bond funds because I don't think they're good investments. They're going to get hurt long-term by inflation, but short-term CDs, for a safety portion of portfolio, okay. European markets, there's some hotter action in markets outside the United States, and I talked about one of them in the last video. Gold and silver look good. So I think it's time not to be a one person or one market investor, one sector investor, much less a one stock person, but to diversify in multiple things. You can't always predict, what one thing is going to go up the most. But if you buy 5 different things, one of those things has a chance to do really well, even if the others don't. So perfect predictions and perfect trading is more difficult in this type of market environment, but it's not necessary if you want to beat the market. And if you beat the market, consistently year after year, then you can generate those big returns, and you can do that in ways that limit your risk. You don't have to make the big gamble. You don't have to buy some silly crypto coin, that you see Elon Musk talking about, or some weird person on Twitter or Instagram or TikTok. The TikTok trader isn't going to get you rich. It's going to take diversification, money management, and so forth, and looking for steady Eddie, quarterly changes in your account, and not big swings in volatility and gambling and turning yourself into a casino type person. No, it's time to step back and take the game much more seriously. And I don't think people are thinking that way. They still have the expectation that what they experienced, especially the new people that got in Robinhood, they think what they experienced from, when they opened up their accounts to the stock market fell last year is what will come back. And they're still trying to play like that's the way the game works. But that was the way the game worked because interest rates went to zero, and they're not going back to zero, probably never again in the rest of our lives. So it's a different market environment. Yeah, I'm not a bear saying it's going to dump and crash, but I'm not going to hype you up and tell you you're going to get rich quick because we're not in a market environment like that either. So if you want more analysis like this, see where I think there are opportunities, hit like on the video, hit the subscribe button, hit the bell next to it. YouTube will send you an alert as soon as my next video is up.